So let's know about debt. Let's know about securitized debt instruments.
Hey, I've been hearing a lot about securitized debt instruments lately, but I'm not quite sure what they are. Can you explain?
Of course, securitized debt instruments are financial products created by pooling various types of debt, like mortgages or loans, together.
Pooling debt. What's the purpose of that?
Well, when you pool these debts together, you create a larger pool of assets, and that pool is then sold to investors as bonds.
Bonds. I've heard of those, but how do they fit into this?
Great question. When the debts are bundled and sold as bonds, investors buy these bonds. Essentially, they're lending money to the issuer of the bonds in exchange for regular interest payments.
So, what happens to the original debts that people owe?
The original debts still exist, but the issuer, often a financial institution, uses the payments they receive from the borrowers to make payments to the bond holders.
I see. Is this a way for the issuer to get quick cash from investors?
Yes, exactly. It allows the issuer to access immediate funds, which they can then use for new loans or other financial activities.
It's starting to make sense. How do investors benefit from this arrangement?
Investors benefit because they receive regular interest payments from the issuer, and they are also backed by the underlying assets, which are the bundled debts. This provides some security for their investments.
So, it's a way to spread risk and make investing in debt more accessible.
Precisely, by pooling these debts and selling them as securities, it helps distribute risk and makes it easier for investors to access different types of debt, without having to buy individual loans or mortgages.
Thanks for explaining. It's much clearer now. But how does it affect the overall financial system?
Well, it can increase the liquidity of the lending institution, making it easier for them to offer more loans. It also allows for diversification in investment portfolios and can attract more capital into the market, ultimately affecting interest rates and economic growth.
That's interesting. It seems like securitized debt instruments play a significant role in finance.